Hi everyone, welcome to today's video. So let me start today's video by talking about a very interesting graphic. It compares the 2022 tech crash vis-a-vis 2000 dot-com crash. Very important chart. So take a look. So this blue line indicates the 2000 dot-com crash and the stocks from their top corrected by almost 78%. Now this green chart indicates the 2022 crash. And here you can see this blip that this has gone down by roughly 15-16%, which is what Nasdaq and S&P 500, which are the US stock indices, they indicate. So people are believing that, from this point, the stock market is going to correct significantly and probably there is another 65% fall that can happen from this point. This is a very scary situation and it gets amplified when you keep on reading these news from different outlets. That that this current crisis is exactly like 2000 dot-com bubble. This has not been covered by just one media house. This has been covered by numerous media houses. So naturally, you will get scared. You will sell all your stocks, go away to Himalayas and start meditating. In fact, I am also going to one of the hill stations. Don't worry, I will continue to shoot videos. But on today's video, we are going to systematically understand with data that is the current crisis like the 2000 dot-com bubble? The answer might surprise you. The answer is both a yes and a no. Very, very important that you watch the entire video. Otherwise, it might confuse you. So let us get the discussion started and three key points about the 2000 dot-com bubble. So we will study it in a historic format, that why did it originate, how did it mature, and how did it pop. So what was the reason for that bubble to burst? And we will compare it to today's circumstances. So first key point is the origination of the 2000 bubble and origination of 2022 bubble. So the 2000 dot-com bubble got formed due to three critical reasons. The first reason was that internet was new. It was a new technology. People did not truly understand the potential of the internet. Probably they overbet on this entire situation that, hey, internet is going to change everything. So let's go pour in crazy amount of money. That brings us to step two, that there was a massive race to get big. The VC industry was not completely mature and some of the internet companies spent approximately 90% of their money purely on marketing. Third key reason is that these companies grew very, very quickly. Just to show you how this mix changed, you need to study the situation in 1995 and compare it with their data in 2000. In 1995, the tech weight of the index was roughly 10%. It grew up to approximately 36%, which is a very fast rise. If you compare this situation to 2022, so yes, even the weight of tech companies in the indices all across the globe is still very much high, but that change or that growth has been gradual. For example, in 2016, the weight of tech companies was roughly 21%. Now it is roughly 36%. So that change has been gradual or slow. So just to put things in context, if you take a look at the growth of tech stocks in the 2000 bubble peak, they grew by roughly 800%, which is a fairly big rise. Currently, in 2022, this growth has been roughly 300%. So even the growth in 2022 has not been that high, so to say. So just to quickly summarize the situation in 2022, yes, the valuations of several tech companies have been extremely high. For example, Netflix, the valuations went crazy. With Tesla, the valuations have gone crazy. With Nykaa in India, the valuations have gone crazy. With Zomato, Paytm, valuations have gone crazy. But have they gone as crazy as they were in the year 2000? The answer is no. The reason for that is that the VC system or the VC ecosystem right now, which puts in a lot of money into these startups, that has matured. So they also understand, because see, at the end of the day, VCs need to make money and they would not be unnecessarily betting things one after the other and keep pumping the ecosystem. They would do it only up to a certain point. So they did learn from their mistake, but have they learned completely? Probably not. I don't know. But the situation is not as scary as it was in 2000. That is a simple point that I'm trying to establish. Now comes the third key path, that yes, the growth has been accelerated even in today's ecosystem, but not at the rate at which it existed in the year 2000. So remember that number, 800% growth in 2000 vis-a-vis 300% growth now. Which brings us to part two of the story, that if you look at the maturing of this bubble, then what is the difference between 2000 and in 2022? So if you study the 2000 data, the maturing of the bubble took place because a lot of VC money poured into the ecosystem. According to some articles, it has been clearly stated that record amount of capital started flowing in Nasdaq in 1997. By 1999, 39% of VC investment were going to internet companies. That year, most of the 457 were related to internet companies, followed by 91 in the first quarter of 2000 alone. So in the total bubble period, 471 IPOs were launched which were tech oriented, which is a fairly big number given the year 2000, especially when internet as a technology had not been matured. Now something similar had happened in 2022, that you must have invested a lot of money in Zomato, Paytm, Nykaa, bunch of other different IPOs, and most of these tech companies IPOs were loss making. Was it a bad sign? Probably, because many of these IPOs were overvalued, no doubt about that. But as a system, did it impact all the type of tech companies that exist at this point? The answer is absolutely not. The primary reason for that is that in 2022, the internet-based companies are not immature anymore. If you consider the history of Apple, Google, even something like Netflix that has fallen a lot, these are fairly older companies. In 2000 or during the 2000 dot-com bubble, these companies were fairly new. So that is one of the key differences that you need to understand. But yes, when it comes to new age companies, for example, Nykaa, which was at one point in time trading at a PE of 1300. Those are like crazy valuations. I myself made videos that, hey, you know what, please do not invest in IPO of Zomato, Paytm, Nykaa, all that stuff. Those videos are still online. You can go and watch it. So these type of new age internet companies, they have gotten hit very badly and it is reflecting in their stock price. But when it comes to mature companies, the hit has not been that significant. And the most important point, that the chances of something like Amazon recovering from this point is much higher than the chances of something like Paytm recovering from this point and making its previous high. So this is the key difference that you need to keep in mind, that in the dot-com bubble, the companies were not mature. The valuations that they received, almost the entire tech landscape received like crazy valuations. That is not the situation right now. Yes, things can be overvalued, but in 2022, the extent of that overvaluation is not that high to begin with. Now, this point can be further understood by looking at that how did the dot-com bubble burst and how did the 2022 bubble burst. So let us take a very quick look. If you study the dot-com crash, what you would notice is that during that time, there were tech companies like Cisco, Oracle, Intel, which were slightly more mature businesses. They somewhat survived the crash. Very few new age internet companies survived, and many of these internet based companies were just fluff companies and they completely evaporated. Now this has been captured by the fact by a term called as upstart.com companies. So these were new age fluffy companies that were trying to woo investors in. They were the ones that went bankrupt, no doubt about that. That pop-up hit the other companies too, but many of those companies came back, which I will talk about subsequently on the video. But what has led to the pop-up of the 2022 bubble? So there are four specific reasons at play. The first and foremost is the COVID situation, that the 2022 bubble is not a tech bubble per se. The dot-com bubble was a purely tech bubble. It was an internal tech bubble. 2022 is not a tech bubble. It started with the COVID crash, or the COVID crashing the economy, so to say. Then it got escalated with Russia-Ukraine crisis. Then it got escalated due to the supply chain disruptions. Then it got escalated due to the inflation problems. And now the Feds are jacking up the interest rate and they are trying to bring the inflation down. And as a result, the growth is slowing down. So this is a major difference between the dot-com bubble and the 2022 bubble, that the dot-com bubble was an internal tech bubble. The 2022 popping of the bubble has happened due to external reasons. So this is a very, very important difference to keep in mind. So what is the entire summary? That do I think that the 2022 stock market is going to crash by another 50%? I would say absolutely not. It might crash by a few more percentage, no doubt about that, but I can almost guarantee this to you, that if the world stops in terms of its growth, the Feds are going to pump up the money again and the markets are going to go up. So please be assured that you can't fight the battle against Fed. They are going to pump up the market if the growth slows down. So there is no way that we are going to fall by 50% from this point, and there are very little similarities between the dot-com crash and the 2022 crash. The 2022 crash is slightly more mature. The tech industry is slightly mature. It is happening due to external reasons, and this is a slightly more mature technology that we are talking about. Now this might lead to a very interesting conversation that, hey Akshat, I've been hearing all this video, all this talk. This reminds me of something which starts with C and ends with O, and in the middle we have ripped. So we are talking about crypto. So the dot-com bubble Does it resemble the crypto bubble? The answer is yes, that the crypto right now resembles the 2000 dot-com bust. No doubt about that. I am not sugarcoating it. Now, you would say and ask me a counter question that, hey, you know what? You have been talking about crypto so positively. Then suddenly you are changing your tune now. Are you going to sell all your cryptos? The answer is no. And I will explain you the logic behind it also. A great place to start would be to analyze a company like Amazon. And I will tell you also why am I picking Amazon as a case study. And then I will relate this to crypto market. So let me quickly talk about the story of Amazon in a very brief manner. So Amazon started roughly in 94-95. It got listed somewhere around 97 and its listing price was roughly $1.7. Then its stock price stayed almost like $7-8 and under $10 till like 1998. And then suddenly 1999, due to the dot-com bubble gaining strength, its stock price rose to approximately $100. So please remember there was a 10x gain on the Amazon share in that time period. Then what happened was that the dot-com bubble burst and the Amazon stock started coming down. In fact, it came down all the way to roughly $5.5-6. So that is how big the Amazon fall was. Just to help you set the context, during the rise of the dot-com bubble, Amazon grew by roughly 10x in a period of a few months. Then it fell by almost 95% within a matter of a few months. Now, very dangerous situation. Why did that happen? Because Amazon as a business was not tested out. It was new, it was leveraging internet and it had great potential. And therefore, now if you study the graph beyond that, you can clearly see that it has become one of the leading companies in the world and the stock price has given massive returns. Now you would say that, okay, why are you comparing like Amazon to a crypto technology? 2-3 reasons. So first and foremost, that Amazon experimented with what idea? It experimented with the internet-based business. It was new. The bubble was there. Now, what is cryptos about? So crypto is an ecosystem. I have been saying constantly on my channel that 99% cryptos are bad. In fact, I will link a video that I had made a few months back about revealing my portfolio. So please go and watch it and please watch the crypto section also. Which cryptos have I been speaking about? So according to me, 99% cryptos are bad. Now, what is the reason for that? The reason for that is fairly simple, that many of the cryptocurrencies are decentralized in nature. Now, decentralized in nature means that it is like a computer code that anyone can come, design their own piece of software and call it a coin or call it an NFT or call it whatever they like to call it. Because of the decentralized nature, cryptos are easy to generate also. So therefore, almost 99% cryptos are bad. If you are picking bad cryptos, of course, you are going to lose your money. So this brings us to the second point. And the first point was that 99% cryptos are bad. Second point means that 1% cryptos are good. Now, I will get a lot of heat for saying that some cryptos are good because a lot of you will point to the example that, hey Akshat, Bitcoin has fallen by roughly 50% in the last 6 months. Yes. Check how much has Amazon fallen in the last 6 months. It has also fallen by 40%. Check how much has Facebook fallen in the last 6 months by more than Bitcoin. The bottom line is that all the tech stocks have fallen, and consider Bitcoin to be a mature tech stock from that perspective. It has already proven itself to be a stable cryptocurrency. But at the end of the day, you need to compare Bitcoin with tech stocks. If you start comparing Bitcoin with value stocks, of course, you are going to get random data. So now comes the natural question that, okay, we want to invest in these top 1% cryptos. Are there any suggestions? Now, this is not an investment advice, but I'll give you some basic viewpoint here so that you get more clarity and not get swayed away by analysis like that you know what, Bitcoin has fallen by 50%. Yes, because it is a tech stock. If companies like Amazon are falling by 40%, then of course something like Bitcoin is going to fall because you need to compare it with a tech stock. So anyways, coming back to the topic, if you're looking to invest in cryptos, then please study the different ecosystem of cryptos. Right now in India, the narrative is that all the cryptocurrencies are the same and there is just one thing which is called as a cryptocurrency. So this understanding is completely flawed. It is similar to saying that, you know what, there is like just one thing called as stock. No, there are 100 different types of stocks, small cap, penny stocks. Even in small cap, there can be different categories, so on and so forth. So you can't compare something like Reliance Com stock with something like HDFC Bank stock, right? So that would not be the correct comparison. So similarly, you need to first and foremost understand the ecosystem of cryptocurrencies. So it could be NFTs, it could be layer 1 blockchain, it could be DeFi projects. Just categorize it, read a little bit about it, Google it. So that is literally step 1. Number 2 is please pick winners in this space. For example, you know for a fact that Bitcoin and Ethereum are 2 leading blockchains. Please go and read about it. Similarly, look at the major NFTs that are gaining prominence, understand more about it. Third point is please understand the utility of a particular cryptocurrency. Let me address this point also by giving you specific example. And this question goes out to all cryptocurrencies. crypto critic. So let me pick the example of gaming-based NFT projects. I will tell you one problem which currently exists in the current video gaming system, and you tell me a better solution without going to crypto-based NFT solution. So the problem is that, for example, when you play something like FIFA or when you play God of War, you exchange your US dollar or INR into that particular ecosystem. For example, you will buy a sword from God of War. Now that money is stuck. Is there a way for you to get that money back through God of War? The answer is absolutely not. You can't sell that sword in that ecosystem, and it is a problem. Now, what is the utility? That with play to earn games, you can go and sell that sword, which is in a form of an NFT, onto a platform like OpenSea, which is pretty much like an Amazon for NFT. Now you tell me, how is this not a utility? Now similarly, I am happy to point out at least 100 such utilities of different cryptocurrencies / NFTs. This is not a push from my side to make you invest in cryptocurrencies, but at least don't say that, hey, this has no utility. Give me a better answer if you have one. Similarly, let me point to another utility, that when I'm transferring money through my HDFC bank account to a friend in the US, I have to pay so much commission. There is at least a 3% commission in terms of the exchange rate. Now I'm losing that commission unnecessarily. If there is a way for me to go to the crypto world and save that commission, is that not a utility? This is precisely what the utility is. Now, how do you check this utility? You can go and read something as the white paper, right? So I will link some of the white papers in the description box of some of the leading cryptocurrencies and NFT projects. You go read it, and if you see value in it, then it might give you an opportunity to explore the next Amazon, because the next Amazon might not come from the stock market. It might actually come from the crypto market, because Amazon navigated a new technology called as the internet, and right now there is a new technology called as blockchain / cryptocurrencies, and whichever good cryptocurrencies are able to successfully navigate this tumultuous technology, they are likely to become the next Amazon. I hope you see this analysis with a rational viewpoint, and I hope you enjoyed the video. Please share it with your friends and like and comment, and I will see you tomorrow.